Welcome. This week on Wall Street was a tug-of-war between optimism and caution, with investors navigating a maze of earnings reports and geopolitical headlines. The market started with a sharp downturn, rebounded midweek, and ended with uncertainty as pivotal earnings season looms. AI excitement continues to propel some stocks, but not all companies are benefiting equally. Investors now demand real profits, not just hype. Geopolitical instability, including new tariff threats, added to the market's nerves, reminding everyone how quickly sentiment can shift. The week highlighted a more selective, discerning market, with strong fundamentals weighed against international risks. As we closed Friday, the appetite for growth was clear, but so was the expectation of continued volatility and unpredictability. As the closing bell echoed through the halls of the New York Stock Exchange on Friday, January 23, 2026, the mood was anything but uniform. Investors across the country were left to interpret a market that sent conflicting signals, with some sectors thriving while others faltered. The Dow Jones Industrial Average took a notable hit, falling sharply as Intel's disappointing earnings forecast weighed heavily on the index and sparked concern among blue-chip investors. Meanwhile, the S&P 500 ended the session almost exactly where it began, its flat performance reflecting a tug-of-war between sectors that gained and those that lost ground, leaving the broader market in a state of equilibrium. In contrast, the Nasdaq Composite surged ahead, buoyed by strong performances from technology heavyweights like Microsoft, Amazon, and Meta. These tech giants continued to demonstrate their dominance, driving the index higher and highlighting the ongoing divide in market leadership. Trading volume was slightly above average, a clear sign that investors were actively repositioning their portfolios. Many chose to sell off underperforming stocks while doubling down on growth leaders, especially in the technology sector. The day's trading underscored just how much influence a handful of tech stocks can have, lifting an entire index even as other sectors struggle to keep pace. Investors were far from passive. Portfolio managers and individual traders alike made strategic adjustments, seeking out resilience and positioning themselves for future growth opportunities in an uncertain environment. With volatility on the rise and economic data sending mixed messages, many market participants are bracing for more turbulence in the weeks ahead. The market's fractured performance has set the stage for a high-stakes earnings season, where every report could tip the balance and shape investor sentiment for the months to come. Zooming out, the week ended with all three major indexes in the red, despite a midweek rebound. The Dow and S&P 500 both slipped, breaking recent winning streaks and signaling a pause in upward momentum. The Nasdaq's near-flat performance showed the powerful influence of mega-cap tech stocks, which nearly offset broader weakness. Disappointing earnings from Intel and renewed geopolitical tensions tapped the brakes on the rally. Investors are growing more cautious, taking profits after a strong run. The week's modest retreat sets a tentative tone as crucial tech earnings approach. The week's biggest corporate story was Intel's dramatic 17% plunge, erasing billions in value and sending shockwaves through the tech world. The scale of the drop was a stark reminder of how quickly fortunes can change in the semiconductor industry, where innovation and execution are everything. The sell-off followed a weak forecast, confirming Intel's ongoing struggles to compete in the booming AI data center chip market. Investors had hoped for a turnaround, but the company's outlook dashed those expectations, raising fresh concerns about its ability to keep pace with rapid technological shifts. While rivals like NVIDIA dominate, capturing headlines and investor enthusiasm with their cutting-edge AI chips and soaring stock prices, Intel's inability to meet demand for advanced chips exposed its lag in the AI race. The company's older technology is struggling to keep up with the new generation of processors powering everything from cloud computing to autonomous vehicles. Investors punished the stock, signaling that promises aren't enough. Tangible AI-driven growth is now required. The market is demanding real results, not just ambitious roadmaps or future projections. The event sent ripples through the semiconductor sector, prompting analysts and investors to reassess the prospects of other chipmakers. It's a wake-up call for the entire industry, as the stakes in the AI arms race continue to rise, highlighting that the AI boom isn't lifting all boats. Some companies are surging ahead, while others risk being left behind as the market becomes more selective and competitive. Intel's stumble is a cautionary tale, reminding us that even industry giants can falter if they fail to adapt quickly enough. In the fast-moving world of technology, market leadership can shift quickly. Companies that once seemed untouchable can suddenly find themselves on the defensive. For investors, it's a reminder to look beyond hype and scrutinize each company's competitive edge. Understanding who truly has the technology and strategy to win is more important than ever. The gap between winners and losers in chips is widening fast, and the next chapter in the semiconductor story will be written by those who can innovate and execute at the highest level. Intel's fall is part of a bigger story, the great sorting of AI haves and have-nots. NVIDIA, the clear AI hardware leader, saw its stock rise again, fueled by global demand for its chips, even from geopolitical rivals. Meanwhile, Intel's struggles put it firmly in the have-not camp, as investors demand results, not just promises. This divide extends to companies like Microsoft, Meta, and Amazon, which are successfully monetizing AI and saw their stocks climb. The market is rewarding those delivering real AI-driven growth and punishing those lagging behind. Upcoming earnings will further clarify which companies are truly capitalizing on AI's promise. Geopolitical anxieties shook the market this week, starting with a sharp sell-off after former President Trump threatened new tariffs on European allies. The announcement sent shockwaves through global financial centers as investors scrambled to assess the potential fallout. Many feared that escalating trade tensions could disrupt fragile economic recoveries and reignite volatility that had only recently subsided. The uncertainty was palpable, with traders and analysts alike watching every headline for clues about what might come next. The move, tied to his ongoing claims to Greenland, injected fresh uncertainty into global trade relations. European leaders responded with concern, warning that retaliatory measures could be on the table if the tariffs were enacted. The prospect of a renewed trade standoff between the U.S. and its allies raised questions about the future of international cooperation and the stability of cross-border commerce. Memories of past trade wars resurfaced, and stocks of companies reliant on international trade dipped. Exporters, manufacturers, and logistics firms were among the hardest hit, as investors worried about higher costs and disrupted supply chains. The ripple effects were felt across sectors, from technology to agriculture, amplifying the sense of unease. The episode was a stark reminder that market performance is deeply tied to political stability. When political leaders make bold or unpredictable moves, markets can react swiftly and sometimes violently, underscoring the delicate balance between policy and economic confidence. Despite the initial shock, the market rebounded as investors bet on strong U.S. fundamentals to weather the storm. Many saw the sell-off as a buying opportunity, confident that the underlying economy remained resilient even in the face of political drama. With midterm elections approaching, analysts expect more headline-driven volatility. Political campaigns and policy debates are likely to keep markets on edge, as investors try to anticipate the impact of potential leadership changes and legislative shifts. Investors should brace for a choppier ride and keep a long-term perspective. Short-term swings may be unsettling, but history shows that markets often recover from political shocks, rewarding those who stay patient and focused on their goals. Political drama will remain a real risk factor for market stability this year. As global events continue to unfold, the interplay between politics and economics will shape the investment landscape in unpredictable ways. Staying focused on fundamentals, not headlines, will be key. For investors, tuning out the noise and sticking to a disciplined strategy may be the best way to navigate the uncertainty ahead. Amid the week's volatility, the Magnificent Seven tech giants anchored the market, with Microsoft, Meta, and Amazon all posting strong gains. Investors see these companies as dominant platforms with diverse revenue streams and a clear lead in AI. Their strength provided a safe haven as the broader market wavered. Now, all eyes turn to next week's earnings from Apple, Tesla, and Microsoft, results that could set the tone for the entire market. Investors will scrutinize not just profits, but AI progress and future guidance. Strong results could reignite the rally. Any weakness could trigger a correction. The stakes for big tech and the market have never been higher. While tech grabs headlines, Friday saw materials and energy sectors quietly outperform. Materials gained nearly 1%, signaling optimism for industrial and construction demand. Energy stocks hit a third consecutive record high, fueled by stable oil prices and strong global demand. The sector is up over 10% year-to-date, making it the S&P 500's top performer. This rotation into value and tangible assets shows the rally is broadening beyond tech. Leadership across multiple sectors is a healthy sign for market durability. The strong performance of energy and materials suggests the economic engine is running on more than just AI. What does this mean for investors? The market is delicately balanced, and volatility is here to stay. The easy gains from AI hype are over. Now, proof of performance is required. Upcoming earnings from the Magnificent Seven will be the key catalyst. Strong results could reignite the rally, while disappointments may trigger a sell-off. Don't ignore the strength in sectors like energy and materials. Diversification is crucial. A balanced portfolio can buffer against tech turbulence. With midterm elections ahead, expect more political headlines and market swings. Stay informed, but don't make rash decisions based on daily news. Focus on long-term goals and fundamentals to navigate the choppy waters ahead.